In 2021, ProPublica leaked something the IRS never wanted you to see. Tax records, the real ones, from the 25 richest people in America. And buried in that data was a number that should have broken the internet. Elon Musk, Jeff Bezos, Warren Buffett, Michael Bloomberg. Combined, they were worth over $400 billion. But their true tax rate, the percentage of their actual wealth growth they paid in federal income tax, came out to 3.4%. 3.4. Meanwhile, a nurse in Ohio pulling $80,000 a year probably paid somewhere around 20%, maybe more. So here's the question nobody in Washington seems able to answer. How do you become one of the richest humans in history and pay a lower tax rate than your secretary? The answer isn't fraud. It's not even illegal. It's debt. Now, stay with me here, because this is where most explanations lose people. They throw around terms like unrealized gains and collateralized lending, and suddenly your eyes glaze over. Let's not do that. Let's tell a story instead. Imagine you bought a small apartment building 10 years ago for $500,000. Today, it's worth $2 million. You didn't sell it, you didn't do anything, but on paper, you're $1.5 million richer. Here's the thing, the IRS doesn't care. Not yet. Because in America, you don't owe taxes on wealth, you owe taxes on income. And as long as you don't sell that building, you haven't realized any income. That $1.5 million in gains, it's just sitting there, invisible to the tax code, like it doesn't exist. This is perfectly normal. Most people understand this part. But here's where the rich do something most people would never think to do. They spend the money anyway. Let's say you need cash, a few million, to buy a yacht, a new house, a political donation, whatever. Normal person, you sell the asset, you take the gain, you pay taxes on it. But if you're wealthy enough, you walk into a private bank, Goldman Sachs, Morgan Stanley, JP Morgan, and you say, "I'd like to borrow $10 million. And they say, "Sure. What's your collateral?" And you say, "My stock portfolio, my real estate, my company shares." And because those assets are worth hundreds of millions, sometimes billions, the bank doesn't hesitate. They give you the loan, often at rates below 3%, sometimes below 2%. Now, think about what just happened. You got $10 million in your bank account. That's money you can spend. It functions exactly like income, but legally, it's not income, it's debt. And debt isn't taxable. So instead of selling your stock and paying a 23% capital gains tax, you borrowed against it and paid 0. You might be thinking, but eventually you have to pay that loan back, right? Yes, technically, but here's where the strategy gets dark. The rich don't pay it back the way you'd pay off a mortgage. They roll the debt. When one loan comes due, they take out another loan to cover it. The collateral keeps appreciating, so banks are happy to extend more credit. It's a revolving door of liquid tax-free liquidity. And if they play this game long enough, if they keep borrowing, keep rolling, keep not selling, something else happens. They die. And when they die, something called the stepped-up basis kicks in. Let's go back to your apartment building. You bought it for $500,000. It's worth $2 million when you die. Normally, if you sold it, you'd owe taxes on that $1.5 million gain. But under current U.S. tax law, when your heirs inherit the building, the IRS resets the cost basis to the current market value, $2 million. So if your kids sell it the next day for $2 million, their taxable gain is 0. The entire $1.5 million in appreciation vanished, tax-free. The loans? Paid off from the estate. And just like that, a fortune passes from one generation to the next, having never been taxed as income at all. This strategy has a name in wealth management circles. They call it buy, borrow, die. It sounds like a dark joke, but it's a literal playbook. And here's the uncomfortable math.
Let's say you have $100 million in Amazon stock. It goes up 7% a year. That's $7 million in annual growth. You borrow $5 million against it at 2.5% interest. That's $125,000 in interest payments. You've effectively extracted $5 million in spending power for a cost of $125,000. Meanwhile, a nurse in Ohio pulling $80,000 a year probably paid somewhere around 20%, maybe more. So here's the uncomfortable math. Let's say you have $100 million in Amazon stock. It goes up 7% a year. That's $7 million in annual growth. You borrow $5 million against it at 2.5% interest. That's $125,000 in interest payments. You've effectively extracted $5 million in spending power for a cost of $125,000. Meanwhile, someone who earns $5 million in salary would pay nearly $2 million in federal taxes. Same lifestyle. One pays 40%, the other pays 2.5%. That's not a loophole, that's a parallel economy. Now you might be wondering, why don't more people do this? And the answer is simple. You can't. Banks don't give cheap margin loans to people with $50,000 in a brokerage account. The rates you'd get, if they approve you at all, are often 8, 9, 10%. At that cost, the math flips. It's not worth it. This strategy only works at scale, when your assets are large enough that banks compete to lend to you, when your collateral is so valuable that the interest rate drops to almost nothing, when you have estate lawyers and tax strategists building generational wealth structures that most people don't even know exist. Buy, borrow, die isn't a hack you can replicate with a Robinhood account. It's infrastructure, built over decades, for people who already have more than they'll ever need. And here's where things get uncomfortable. Because this isn't about hating rich people. This isn't about envy. This is about a tax system that defines income in a way that only captures certain kinds of wealth. You work a job? Taxed. You sell a stock? Taxed. You inherit $1 billion and borrow against it forever? Not taxed. The richer you are, the more your wealth looks like something the IRS can't touch. And every few years, politicians float ideas to fix this. A wealth tax, taxing unrealized gains, closing the stepped-up basis loophole. But these proposals almost never pass, partly because they're complex, partly because the people who benefit from the current system have a lot of influence on the people who write the laws. So the system persists. But here's the thing nobody talks about. This whole strategy has a hidden risk. It only works when asset prices go up. In 2022, when the market dropped 30%, some billionaires faced margin calls on their loans. Suddenly, the collateral wasn't worth enough to back the debt. They had to either sell assets, triggering the very taxes they were trying to avoid, or find new ways to shore up their positions. Buy, borrow, die assumes the market always recovers, that interest rates stay low forever, that banks never lose faith in your collateral. For most of history, that bet has paid off, but history isn't a guarantee. So where does this leave us? The wealthy didn't break the law, they just understood it better than everyone else. They recognized that in America, the tax code doesn't treat all dollars equally. A dollar you earn is taxed immediately. A dollar your assets generate can be deferred indefinitely, and if you're patient enough, erased entirely. And the rest of us, we're playing a different game, one where income shows up on a W-2 and disappears into withholdings before we ever touch it. Maybe that's fair. Maybe the system incentivizes investment, rewards patience, drives growth. Or maybe it's a structure designed by people with accountants for people with accountants. Either way, the next time you hear a billionaire say they don't take a salary, as if that's humility, remember what they're not saying. They don't need a salary, because they've figured out how to live off debt. And in America, debt is the most tax-efficient income there is.